I know you'll have read the runes and been through the Bank of England minutes. The committee split, so 3 of the 9 members actually wanted to do a 0.5% interest rate rise rather than just a 0.25% interest rate rise. There's a lot of momentum now, isn't there? How high do you think rates could go?
Well, it's really interesting because if we look at the market expectations for where rates are going to go, they're looking at a move to around 2.25% by the end of the year.
From 1% now, big
exactly.
increase.
So another 5 quarter-point interest rate hikes. But if you look at the average economist's expectations, they're looking for rates to move to just around 1.5% by early next year. So there's this big discrepancy going on. And it tends to be that the markets are repricing the expectations every single day, every minute. So they're a lot more sort of up to the minute. But at the same time, we haven't seen that many revisions from economists because they move slightly more slowly. So the expectation is that both will sort of meet somewhere in the middle. But it is a really, really difficult balancing act that the central bank is trying to carry out here because it's using a demand-side tool, so a tool that focuses on consumer spending, on mortgages, on loans, to tackle what's largely a supply-side problem. It's being driven by external factors like supply chain bottlenecks post-pandemic and also the war in Ukraine that's pushed up energy prices sharply higher. And, of course, like your guest said, he doesn't want to inadvertently induce a recession.
Indeed.
And growth is very, very low at the moment. In February, it was just 0.1%. So pretty much
And that's why
nothing.
Ben Laidler talked about stagflation, that combination that you and I have talked about a lot for months here on The Money, of high inflation and economic stagnation. So inflation plus a recession, which is back to the 70s, which is a really bad place to be in.